It's been said that if you go broke, you'll go broke, and Target appears to be a prime example of that. The firm spent more than 60 years developing its brand before becoming a household name, and now it is one of the largest department store chains in the US. But after receiving harsh criticism for introducing contentious products and placing them next to toys, even Target stockholders are now expressing the opinion that the store seems to be dying. Target store sales have begun to decline at an unprecedented rate as a result of the widespread boycott by customers. Some refer to the beer brand's swift downturn as Bud Light's 2.0, citing a disastrous campaign that was launched earlier this year and caused Anheuser-Busch's shares to plunge by 45% and sales to decrease by more than $400 million since June. Although Target is now going through a lot of difficulties, the company's collapse was long overdue. Target's downturn has happened overnight, but beneath the surface, the firm has been struggling for years, declining further in spite of many attempts to turn it around. Target announced a few months ago that shrink, the term used by the industry to describe the loss of inventory brought on by shoplifting, was severely hurting its bottom line, and it anticipated additional losses of up to $500 million over the previous year, when theft losses were projected to be between $700 and $800 million. That implies that this fiscal year's losses might exceed $1.2 billion. The largest retail trade association in the nation, the National Retail Federation, reported that its most recent security study of over 177 shops revealed that shrinkage averaged 1.6% in 2022, resulting in losses for the retail sector as a whole of $112.1 billion. Based on the study, results organised shoplifting episodes accounted for the largest share of shrinkage, almost 65%. In addition, compared to a year ago, almost two-thirds of respondents stated that they were witnessing an increase in hostility from organised retail crime perpetrators. The NRF observed that while retailers are always refining their loss prevention strategies, more harsh steps are occasionally necessary. A third of the shops questioned stated this tendency has caused them to close their stores, and 45% claimed that they had to shorten their hours of operation. Furthermore, 30% more stated that they had to alter or decrease the range of products offered in their establishments due to retail theft. Target can't afford to lose another $1 billion in market value in 2023 after already losing over $14 billion. Thus, it is attempting to save its business by employing its final resort. The typical American consumer is exhausted, having lost a great deal of purchasing power and bearing enormous debt, while US retail industries rely largely on discretionary spending. The entertainment industry has been particularly severely affected. Media behemoth and specialty store Disney has reported a collapse in its operations, with over $1.4 billion in streaming losses and a 39% stock decrease this year to date. Layoffs of employees are an inevitable consequence of the company's financial problems. Disney announced a hiring block last month and stated that it will begin evaluating employees' productivity with the intention of making layoffs in order to become a more agile organization. In recent months, the shares of numerous merchants have lost momentum due to market instability. The most recent Macy's, Kohl's, and Gap figures highlighted the uncertain situation facing American retailers as the holiday season approaches. The retailer situation deteriorated last year as sales started to decline and inventories kept rising. The firm started to fall after executives decoded to provide steep discounts in an attempt to get rid of the inventory, but American consumers continue to cut back on discretionary spending. Investors are still selling off large quantities of the firm's shares because they think the boycott of customers will continue for several months and negatively impact sales prospects in the upcoming quarters. The company has provided poor returns. The firm may see slow sales patterns in the upcoming quarters, which would indicate a lackluster market for a couple of its core product lines. In a recent report, Wall Street analysts and MIT engineers who make up Trevor's team stated, "We expect the company's shares to likely remain under pressure in the short term." Additionally, in the second quarter, comparable digital sales decreased by 10.5%. That was, all things considered, akin to splitting in the wound. Although there are many indications that the reduction may be considerably worse, analysts are currently projecting that revenue will drop by another 5% in the third quarter. The cost of raw materials, packaging, labour, shipping, marketing, and inventory are all on the rise, and thus this year has seen an unprecedented spike in energy costs. As a result, retailers are under the worst operational cost pressure in decades. Discounts are extremely costly to a retail business profits and loss. This Christmas season, many companies are not in a strong enough financial position to offer discounts even if customers want to inspect them. Research from Bright Pearl indicates that 1 in 4 businesses might experience a crisis point in cash flow or supply chain problems in as little as 4 weeks. In the 6 weeks leading up to Christmas, many of these businesses stand to make or lose their entire yearly profit. Thus, according to Mark Hook, a spokesman for inventory planner by Sage, cutting back on the quantity and magnitude of Black Friday deals or abstaining entirely would be one way of those looking for a more lucrative holiday shopping season. According to Hook, it could be the only option for merchants to weather the current cost crunch and guarantee a more lucrative trade time. This Black Friday, according to Bloomberg, will likely be the last for Sears and Kmart, two companies that once proudly dominated the retail scene. It will also certainly cause a great deal of fear in the industry. According to Bloomberg, the two chains that came out of bankruptcy 3 years ago are unlikely to make it through the current slump. Eddie Lampert, the principal owner of both brands, hasn't made a profit in years. Therefore, many retail analysts are speculating that he would close the remaining outlets. The retail scene was dominated by Sears shops less than 20 years ago, and they drove out many locally owned Main Street establishments in the same manner that department stores would eventually be forced out of businesses by big box retailers. The anchor of many malls that contributed to the expansion of American suburbia was Sears. It was a firm that genuinely transformed America, and it's now but a shadow of its former self. A recent Clever real estate survey indicates that 39% of Americans cannot afford to buy for the holidays, and 61% of holiday consumers say they would adjust their spending this year due to inflation. A little over half of customers, 57%, who want to spend less on Christmas shopping in 2022 cite growing costs as their main reason, and around the same percentage also mentioned financial concerns. Retailers have already used a number of strategies to draw in customers and boost sales volume, such as holding Christmas specials earlier than usual and offering steeper discounts to move inventory. Many Americans have already paid off their credit cards in full at this time in order to keep up with the skyrocketing expense of living. Credit card balances increased by 15% in the last month, and the rate of delinquency also increased, hitting a 20-year high. Pointing out that the precarious financial circumstances facing American customers are just another indication that the prolonged recession is placing several merchants in a very unsettling scenario. A significant trend that is detrimental to American merchants is a steep decrease in middle-class household spending power. According to economist Peter Schiff, the Bureau of Labor Statistics recently released statistics indicating that half of all American workers earn less than $3,133 per month in the previous year. Given the current state of the economy, this amount is insufficient to sustain a middle-class lifestyle. Given that 63% of Americans live paycheck to paycheck, nearly two-thirds of them, it is evident that more people left the middle class in 2022. By 2021, that percentage had dropped to only 57%. When combined, all of these tendencies will destroy a lot of barely hanging enterprises. Furthermore, the retail scene could be much more empty this winter than most people would have thought. Because of this, we would like to urge you to take advantage of your favourite retail establishments while you can, as many of them may soon have to close their doors for good due to increasingly difficult circumstances facing our shops. That's it, guys. Beware of the collapse. Comment on your thoughts on this and subscribe to our channel.